Hello. Today is April the 14th, 2021, and it's been just over a year since the global pandemic has started. And from a financial markets and investor perspective, it's been a very interesting year. We've had government imposed lockdowns, which resulted in slower economic activity, especially in the leisure and travel sectors of the economy, with airlines, cruise ships, hotels, and so on getting affected. And also office buildings, office landlords, mall landlords, retail, and so on. The result has been that we've had a lower GDP, lower income since a year and a bit ago. Yet we've had now, after the initial stock market crash in March of 2020, we had a complete recovery to the point where we're making all-time highs in stocks, in residential real estate, in other asset classes, and commodities are recovering and they're pretty hot. So a lot of asset prices have gone up. Of course, that's understandable given the fact that the central governments around the world reduced interest rates to close to zero. Then governments introduce fiscal stimuli in the form of fiscal spending, expansive policies, and last but not least, the central banks engaged in quantitative easing, purchasing assets and pushing the prices higher, and supporting the global, especially debt markets, including corporate and high-yield corporate bond debt markets, i.e. the less creditworthy borrowers. What are we to do now, a year, 13 months later or so? First of all, as a financial advisor, and probably most of us in the business, we don't particularly like governments intervening in markets the way they have over the last 13 months. But then again, we invest in the markets that we have and not the markets that we wish we have. So we're trying to do the best we can under the circumstances. The first thought that comes to mind after everything has come up so much would be to have, depending on what people have in their portfolios already, to have something in the portfolio that has a chance of doing well if the market takes a bit of a breather or comes down, which we don't anticipate, by the way, because the forces behind the recent stock market rally are very powerful. There's markets that are awash with liquidity. And until such time as the central banks start removing such liquidity, it doesn't look likely that markets will fall, whether it's real estate or stocks or other assets. How soon that will happen, it's everybody's guess. The Fed said it's unlikely that they will be raising rates for the rest of the year. They may be forced to if markets overheat or if inflation gets out of control, which we don't expect again. But if something like that happens, it's nice to have something in the portfolio that could hold its value or ideally even go up. The only thing that comes to mind at the moment, as most asset prices have moved up, is gold. And gold is perhaps a little bit higher than it was 13 months ago, but nowhere near as much as other asset prices. And it's traded more as a fear indicator. So as the fear has subsided, gold prices came down from over 2,000 to, let's say, high 1600s, 1700s, in the mid 1700s where we're trading right now. And again, while we don't anticipate fear to come back in the markets anytime soon, this is an attempt to diversify what should already be for most investors an offensive portfolio and a good year for them, especially in 2021 now. So a good ETF for Canadian investors is the Purpose Gold Bullion Fund, symbol KILO, kilo, or KILO.B, hedged or non-hedged version for currency. And those ETFs are RSP eligible and TFSA eligible and so on. And the gold is held in physical form and in vaults in the fund's name, I believe. For larger portfolios, again as a hedge, it might not be a bad idea for people to actually have a portion of the portfolio in physical gold where they have possession of it, such as gold coins or silver coins as well. Maybe 80% gold, 20% silver, because silver coins are not worth as much, and keep it in their safes in their own houses, or the safety deposit boxes of banks or other vaults in secure locations, and hold it for a long time. Digital currencies is something that central banks are thinking of implementing down the road. If at any point digital currencies are the only way we use money, and they are in fact money, and cash becomes useless or not the preferred way of doing business, gold may be the new cash, or silver most likely, because silver is not as valuable for small transactions such as dealing with tradespeople and so on. So there may be some practical reasons to have some of those things around. So that's idea number one. Now we have some other ideas for recommendations for the next few months and let's say the next year. Financial services and banks, they are recovering now after the initial hit to their balance sheets due to provisions for losses, as these losses are not materializing at the rate that they had originally anticipated, and the economy is reopening, and there's lots of liquidity. Things are getting better for them. So the case for banks is good now. And one such bank is Union Bankshares, a symbol UNB on the New York Stock Exchange. Reasonable profitability, a reasonable valuation, good prospects, and usual characteristics that we like for stocks. And another stock that we like these days, it's in the steel business. Ternium, flat steel producer operating in Mexico, Brazil, Argentina, and Colombia, and the United States and Central America. This symbol is TX. Construction for real estate and for other businesses, for other purposes rather, is doing pretty well right now. So that could be a business that will benefit from this, and has benefited for the last few months to a year, let's say. And that's something that if people already don't have exposure in their portfolio, that would make sense for them to have. If you guys have any questions, please consult with your financial advisor or contact us to see if these investment ideas have a place in your portfolio. Thank you.